Welcome back. Spring officially starting on Thursday, even if it doesn't feel like it in some parts of the country. That's historically when the housing market heats up, and it appears that just in time for spring, adjustable rate mortgages are back in style, even though it seems probable interest rates will be higher when these very mortgages readjust. Is this doomed to end badly? Let's bring in two real estate pros, Tim Root of the Collingwood Group and Fred Glick of U.S. Loans Mortgage, Inc. Great to see you both. Fred, you're saying this is going to end badly.
Well, yeah, there's a lot of little quirks. I mean, I don't really have a big problem with adjustable rate mortgages as long as you know the devil's in the details. And what I've seen primarily is that every lender is changing so that after the initial period of, say, 5 or 7 years, you could have a cap of 5% over what you start with. And that can be a dramatic jump after the 5 or 7 year period of which you have a stable lower payment. And also, a lot of people are kind of being pushed into these loans because of the Dodd-Frank CFPB ruling of the 43% back-end ratio. Used to be you could go a little
English,
bit higher.
What does that mean? Yeah,
Okay.
Put that in English for our viewers.
You take your new mortgage payment and your other recurring monthly debts divided by your income, and it is not allowed to exceed 43% of your total income.
And why is that pushing people into adjustable rate mortgages?
Because we used to be able to go higher. People would put 50% down and be able to go to, say, almost a 50% ratio, and it would be a safe loan. But accordingly, the CFPB says, no matter what your loan to value is, 43% is what's going to be a qualified mortgage. So if you have a fixed rate and it's, say, 4.25%, and you don't qualify at 43, maybe you then take a 5-year ARM at 3.25, and you do qualify. But now in year 6, maybe you don't have the same job. Maybe things have changed for you, and it's a big surprise.
Well, I mean, Fred, what do you think accounts for the popularity of adjustable rate mortgages again?
I think the rates are very low, and they've remained low because LIBOR has remained low, which is basically what they base it off of. And people just like that lower monthly payment.
Exactly.
There are a lot of jumbo product out there that the banks are portfolioing because they're able to, and they want to attract people into the bank through the mortgage and then get their assets to manage.
But Fred, do you think for the most part,
loans?
because what's happening, I'm sorry, I don't mean to jump in, but for a lot of the banks making these adjustable rate loans, they're holding them on their books because they're betting that those rates are going to go higher and they'll benefit. So don't you think that for the most part, Tim, I'm sorry, that people who are taking out these mortgages should know that the banks are positioning for the rates to go up, which is the very thing that will cut into those bills, that'll make it much more expensive down the road?
Yeah, hi, Kelly.
Absolutely.
Sorry, Tim, go
I'm sorry,
ahead.
is this? Oh, Tim, I'm sorry.
Yeah, no worries, no worries. So let me see if I can distill this down a little bit. I mean, so homeowners, home buyers, they're very myopic. They're looking at really what's the spread between a 30-year fixed and an ARM. And in times where the yield curve steepens and it's noticeably more expensive to get a 30-year fixed than an ARM, which is what's happening right now, it's about a 1.2% differential, they're choosing ARMs. They've done it historically. And a good way to think about a 30-year fixed is it's a hedge. It's an insurance policy against future increases in your rates and your payments. Over the last 30 years, that's been a bad bet because interest rates have gradually come down or little dips up and down, but overall, ARMs have outperformed them. So it makes a lot of sense to continue that trend as affordability starts to drop again when interest rates pop up.
Quick
same
final
thing
word.
has happened 30 years.
Go ahead.
It's the same thing that's happened for the last 30 years.
And we can say a full sentence, please. We'll just finish the point.
Yeah, I'm
Fred,
sorry.
Go ahead.
Oh, sorry, Kelly. Go ahead.
Okay, guys, we're going to leave it there.
Where we're going,
we'll come back to this topic. Appreciate it. We're getting our wires crossed. Thank you
Thanks,
so
Kelly.
much for
No
joining
problem.
us. Please, everybody, go to the Wall Street Journal, read the piece, and that'll give you much more of the information. College basketball brackets are set, and Domino's is set to lead the fast break for fast food during the NCAA tournament. Up next, Patrick Doyle, the company's CEO, is going to tell us